Corporate actions. Hello all. Welcome to the Corporate Action module. In this series, we will look at modules. Describing the corporate action. Identifying the types of corporate action. Important dates or timelines in connection to corporate action. And the impact of these corporate action to investors and issuers. What is corporate action? A corporate action is any taken by a company, generally enacted by its board of directors, that has a material impact on the company and its shareholders. Normally, corporate actions involve mergers and acquisitions, spin-offs, issuing dividends, or even changing a company's name or brand. These corporate actions exert an impact on the individuals are tied to a company. The concerned parties include preferred and/or common shareholders, stakeholders and bondholders. Now let's look into why corporate action are done. For capital restructure. Through paying off the debts or bonds, merger, acquisition and changing the reserve ratios. For influencing the share price. By either stock split, issue of bonus shares or through reverse stock split. Mostly, corporate actions are done to distribute the benefit to its investor in the form of dividends. These corporate actions directly impacts the investors on their investments either on the cash balance or security position balance. Classification of corporate action. All corporate actions can be broadly classified into three, namely mandatory, voluntary, and mandatory with choice. Mandatory. In this type, the investor's participation in corporate action is mandatory. No investor intervention is required. Mandatory corporate actions are enacted by a company's board of directors. Example is dividend. Shareholders need to do nothing aside from collecting the cash dividend on their shares. Mandatory, in this context means that shareholders have no choice but to agree to the action being taken. These mandatory corporate action impacts on investors' cash or security or both. Voluntary. Voluntary corporate actions involve an activity in which shareholders opt to be participants. In order for the company to move forward with the corporate action, the shareholders must respond. A prime example of voluntary action is a tender offer. Because it is voluntary, shareholders may participate in the tender offer or refuse. In voluntary corporate action, the investor controls the impact on cash or security or both. Mandatory with choice. It is a mandatory corporate action for the shareholders, but they are given an option to choose from several options. A common example is a cash or stock dividend payout, with one of the options as default, where the shareholder may or may not submit their election. The default option will be applied. Here, the investor controls whether corporate action impacts his cash or share, but not both. Next, we have types of corporate action along with examples. Mandatory. Under mandatory, we have dividend or coupon payments. Dividends are payments made by a company to its shareholders out of its post-tax profits. These payments are not fixed, they move up and down like a company's share price. They can be paid once, twice, even 4 times a year, or a company can even elect not to pay a dividend at all. Restructuring related, splits and reverse splits and spin-offs. When a stock is split, a company increases the number of shares, but their actual value doesn't change. For example, you own 50 shares in a company at rupees 10 per share, which gives you an investment valued at rupees 500. Then, if the company were to announce a 2:1 stock split, you would then own 100 shares, each worth rupees 5, which still means your investment is valued at rupees 500. This kind of mandatory corporate action won't change the value of a company, but could well change investors' perceptions of the company. A company that wants to attract new shareholders, but feels that its share price is too high to do this, might arrange a stock split to lower the stock's price and making shares more affordable. Reverse splits are just opposite to splits. The company reduces the number of shares, thereby increasing the value per share without change in the total investment value. Spin-off leads to a creation of an independent company through sale or distribution of new shares of an existing business. Bonus shares. Bonus share is an additional share given to the shareholder without any extra cost, based on the number of shares you own. Though the issue of bonus shares increases the number of shares. Mergers and takeovers. In a merger, two or more companies agree to merge themselves in order to increase the scale of operation and profitability. Similarly, an acquisition is an event where the bigger company acquires a smaller for further expansion. Next is voluntary. Under voluntary we have rights. In rights issue, where companies offer shares at a special price to existing shareholders. It could be a great opportunity to increase your shareholding in a firm. Companies turn to rights issues when they are looking to raise money, maybe for expansion, or to pay down debt. New shares may be attractive to shareholders, because they'll be cheaper than the current market price. However, shareholders are not obliged to buy them. Tender offer. It is an offer to buy all, or some of the shareholders' stock positions. The offer price may be payable in cash, stock, or a combination of both. An offer to buy back a bond. The offer may have a set price that is determined by the company, or based on a specific reference yield calculation. Conversion. The conversion element comes in when preferred stock is converted to common stock, which shareholders seek to do when there's an appreciable rise in the value of common shares. The company can also issue convertible bonds as another means of raising funds, and these operate in a similar way to preferred stock. Delisting. Delisted shares refers to the shares of a listed company that have been removed from the stock exchange permanently for buying and selling purposes. However, you can sell it in over-the-counter market. Delisting could be voluntary, depending on the reasons for delisting. Mostly, mergers with other company, amalgamation, or non-performance are few reasons for voluntary delisting. Voting. Stockholder voting right allows shareholders of record in a company to vote on certain corporate actions, elect members to the board of directors, and approve issuing new securities, or payment of dividends. Shareholders can voluntarily cast votes at a company's annual meeting. If they cannot attend, they may utilize a proxy vote to convey their wishes. The last one is mandatory with choice. Dividend coupon with options. Using the example of dividends, when the company offers dividends in the form of stock shares or cash dividends, with the shares being the default option. the shareholder may choose the form of a dividend payout. In the event that the shareholder doesn't submit a choice, then, the default option, shares of company stock, is the form that the dividend will be provided in. DRIP. Normally, when dividends are paid, they are received by shareholders as a check, or a direct deposit into their bank account. DRIPs, which are also known as dividend reinvestment programs, give shareholders the option of reinvesting the amount of a declared dividend into additional shares, which are bought directly from the company. Here, in both the examples, the dividend is mandatory. However, the investor had the option to receive in the form of additional shares or cash. Corporate action timelines. Announcement or declaration dates. The first two important dates that a company sets are the announcement date, in case of a rights issue or a spin-off, and declaration date, in case of a cash dividend payment. This is the date on which the board of directors announces to shareholders, and the market as a whole, that the company stock will undergo a particular corporate action. Ex-date. This is the date on which security trades without the benefit of corporate action. An investor buying security on or after the ex-date is not eligible for the corporate action by the company. The ex-dividend dates are set by the stock exchange where the company's stock is traded. In dividends, the ex-dividend date typically occurs up to 3 days before the record date. Record date. This is the date on which the company looks at its records to see who are the shareholders of the company entitled for the corporate action, like stock offering, rights issue, or stock split and dividends. An investor holding shares on record date will be eligible for the corporate action on that share. Payment date. For dividends, the payment date is the date on which the dividend is paid to shareholders. Dividend payments may be either mailed or electronically transferred to the accounts of shareholders. Finally, what happens if we miss out actioning a corporate action from our end? Reputational impact. Due to incorrect transactions on the books. Downstream impact. To all the dependent processes. Financial exposures. May lead to claims and penalties. Incorrect decisions and actions. Missed investment opportunities for our end clients. Debrief. Here we come to the end of this module. Now you should be able to explain corporate action. Identify the types of corporate action. The important dates associated with corporate action. The impact of various corporate actions to issuer and investor.